It's time now for us to conclude the conference with a panel discussion on coordinated policies for global liquidity and robust growth. For this discussion, Professor Sargent will serve as the moderator. Please welcome Professor Sargent and all the panelists.
Okay. So I don't know whether we can coordinate policy. I don't even know whether I can coordinate this panel well. So I'll try. So how about this? 15 minutes per person, and we'll go in alphabetical order. So we'll begin with comments from In-Jun Kim.
Thank you for inviting me to this symposium. Dealing with the theme of this symposium, assessing global liquidity in a global framework, I will focus mainly on the case of Korea. As we all know, major advanced countries have been expanding money supply to an unprecedented level, not only by lowering interest rate to almost 0 point, but also by implementing quantitative easing policies. Such liquidity expansion has both positive and negative side effects. A surge in global liquidity undoubtedly contributes to preventing world economy further dipping into global economic recessions. Especially unconventional monetary policy contribute to addressing market dysfunction and repairing the transmission mechanism of the monetary policies. However, expansion of global liquidity, in particular persistently low interest rate, may have delayed necessary reforms in fiscal, structural, and financial sector in advanced countries that were hit by the crisis. Another adverse side effects of expansionary monetary policy through purchasing bonds is that government monetize fiscal deficit and as a result accumulate a large amount of sovereign debt. A main purpose of expansionary monetary policy is to boost domestic demand. However, such policy also affects the currency value at the same time. Therefore, expansionary monetary policy is often regarded as an indirect way to influence foreign exchange rate. In the world of high capital mobility, it is important to evaluate whether capital receiving countries benefit from expansionary monetary policies of advanced countries. Immediately after the global financial crisis, many emerging economies had a hard time securing foreign currency liquidity. With the sudden outflow of foreign capital, some emerging countries were on the verge of a currency crisis. Expansion of global liquidity helped emerging economies in securing foreign currency liquidity. In this sense, emerging economies benefit from expansionary monetary policies of US and Euro area. Expansionary monetary policy of advanced countries also contribute in boosting global demand for export goods of emerging economies. The pace and extent of global liquidity expansion, however, were too excessive because advanced countries competitively implement both conventional monetary expansion and unconventional policy measures such as quantitative easing. For example, monetary base of advanced countries almost tripled over the past 5 years. Monetary expansion of advanced countries increased cross-border capital flows into emerging economies. Such capital inflow result in significant appreciation of currencies of emerging economies. The pace and extent of appreciation, as well as the volatility of exchange rate, have been quite excessive. Excessive currency appreciation in a short period of time and volatile exchange rate movements have negative impacts on emerging economies. Large inflows of foreign capital can fuel asset market bubbles and undermine financial stability of some capital recipient countries. Currency appreciation also decreases the competitiveness of export sectors of emerging countries. Large amount of foreign capital inflow and sudden reversal in capital flows generate a boom-bust cycle in emerging economies. Due to weak and fragile financial sector, foreign capital inflow lead emerging economies into economic crisis in many occasions. The theory of impossible trinity tells us that free capital flows, exchange rate stability, and independent monetary policy cannot be achieved at the same time. In the face of a surge in foreign capital inflows, liquidity receiving countries generally have three policy options. First option is to maintain independent monetary policy and free capital flows, while allowing currency appreciation and a resulting volatility of exchange rate. The second option is to keep exchange rate stability and retain independent monetary policy while controlling foreign capital flows. Third option is to maintain foreign exchange rate stability and free flows of foreign capital, but give up independent monetary policy. Which option is the right option for an economy depends on economic situation of liquidity receiving country and the effectiveness of policy options. Because of past experience in currency crisis in 1997, Korea has been cautious in dealing with sudden surge in capital inflows and a possible reversal of capital flows. Because monetary expansion in advanced countries can bring large capital inflows into emerging economies and possibly generate excessive currency appreciation, Korea's recent policy aims at reducing negative effects of capital inflows, especially currency appreciations. However, the situation was quite different at this time, immediately after the collapse of Lehman Brothers. Then Korea mostly worried about sudden capital outflows and potential currency crisis. At that time, Korea was quite vulnerable to the sudden outflow of foreign capital, even though Korea had accumulated more than $260 billion in foreign reserve as a buffer. Before Japan implemented so-called Abenomics, which targets raising inflation rate up to 2% and doubling monetary base within 2 years, Korea has wisely managed the surge in global liquidity and subsequent inflows of foreign capital. In particular, Korea has avoided excessive appreciation of Korean won and maintained price stability with relying too much on managing capital flows. Abenomics, however, immediately changed the whole picture. Even though Japan claims that the main purpose of Abenomics is to boost domestic demand, the announcement effect of Abenomics led to free fall of Japanese yen. As you know, within several months after the announcement, Japanese yen depreciated against the dollar more than 25%, while Korea won appreciates slowly against dollar during the period. There are mixed opinions about Abenomics. My personal opinion is that Abenomics is well designed for Japan as long as Japan can manage its sovereign debt. Japan can manage its sovereign debt as long as it can keep average long-run nominal interest rate below average long-run nominal growth rate. Advanced countries such as US and Eurozone countries are not in a position to blame Japan for manipulating its exchange rate through monetary and credit policies. Those advanced countries already lowered their interest rate near 0 point and in addition took quantitative easing policies. Abenomics, however, have direct negative impacts on the competitiveness of exports of neighboring countries by artificially and indirectly depreciating Japanese yen against currency of its neighboring countries. Korea, as one of East Asian neighboring countries, suffered most significantly from Abenomics. Korea's major export industries compete with Japan in the world commodity market, and the yen-won exchange rate is the main factor in determining the competitiveness between two countries. In the face of Abenomics, Korea is forced to choose 2 out of 3 policies in the impossible trinity. If Korea wants to prevent excessive appreciation of won and volatility of exchange rate, it should either give up independent monetary policy or manage capital inflow to a certain level. My policy recommendation is only my own opinion, is that as a first step, Korea needs to take expansionary monetary policy to boost domestic demand and to curb excessive appreciation of Korean won. Korea has 2 monetary policy options: conventional monetary policy and aggregate credit ceiling loans. Aggregate credit ceiling loans can be regarded as a special kind of quantitative easing policies. Objective of this policy is to address market dysfunction and repair the transmission mechanism of monetary policies. Over the past 5 years, the average growth rate of Korea was just below 3%. To boost domestic demand and recover growth potential, Korea needs to take expansionary monetary and fiscal policies. Korea can benefit by implementing similar monetary policies that advanced economies have taken, as long as price stability is not hurt severely. Lowering interest rate and expanding aggregate credit ceiling loans to sectors hit mostly by global financial crisis can help Korean economy recover from deep recessions. Stimulus policies can also help suppress excessive appreciation of Korean won. If Korea decides to take stimulus policies, Korea may review all the possible monetary policy targets, including flexible inflation targeting and nominal GDP targeting. Policy objective of central banker should include not only price stability, but also financial and economic stability. If Korea fails to manage exchange rate stability, even after the adoption of stimulus policies, Korea has 2 other options: foreign exchange market intervention and capital management. If foreign capital inflows are beyond Korea's absorptive capacity and the extent of won appreciation is unrelated to economic fundamentals, these 2 policy options should be reviewed to maintain exchange rate stabilities. There is a significant asymmetry in foreign exchange market intervention in fighting against currency appreciation vis-à-vis currency depreciations. In order to prevent excessive depreciation, a government needs to sell dollars. In the case against excessive appreciations, the government needs to sell its own currency and buy dollars. Intervention against appreciation results in an increase in money supply and foreign exchange reserve. To prevent inflationary pressure and asset market bubbles, a sterilization policy needs to be implemented together with foreign exchange market interventions. However, government always needs to keep in mind that failed intervention is worse than no interventions. To guard against the sudden reversal of foreign capital, government needs to build up sufficient amount of foreign reserve. It has to bring a consensus on the optimal size of foreign exchange reserves. Those who argue for a sizable foreign exchange reserves emphasize that foreign reserve play a role as a war chest as a source of liquidity and as an instrument for inspiring market confidence. Korea also should prepare for the case that exit of quantitative easing policies of advanced countries can lead to a sudden outflow of foreign capitals. Argument against holding a large amount of foreign reserve is centered on opportunity cost of holding a reserve. IMF new instrument, bilateral and multilateral swap lines, can serve as effective alternatives to foreign exchange reserve. Another option is to manage foreign capital flow. Economists present different opinions on the effectiveness of capital management and optimal tools to implement effective capital management. Three main components of foreign capital flows are direct investment, portfolio investment, and banks lending and borrowing. Rather than directly maintain capital flow, however, it's more desirable to adopt macro-prudential regulations on capital flows. To deal with the sudden surge of foreign capital inflow, Korea once adopted policies of putting ceilings on foreign exchange derivative positions and impose a macro-prudential stability level. Even in this case, it should be temporary and used to prevent excessive appreciation of Korean won, only because a sudden reversal of foreign capital flows can always happen without warnings. Thank you very much.
So thank you very much. Our next panelist is Jean-Pierre Landau.
Thank you very much. Maybe I'll follow up on Professor Kim and also on what I said earlier, and just look briefly on three possible big and very difficult policy issues. The first one, which I would call monetary policy coordination, and I put coordination between commas because I think this is by itself the term is highly controversial. The second issue will be the question of global safety net, and the third issue will be the question of segmentation in global capital markets, which is occurring right now, and what kind of policy implication it may have. So on monetary policy coordination, the case has been made for a long time. It has been made much more strongly in the recent weeks, including in a very subtle but no uncertain term by the general manager of the BIS in a series of recent speeches. He didn't speak about coordination, but he spoke about internalizing the effects of union policy on others, which is of course a different but closely related concept. And of course the case rests, if there is a case, it rests on what I said a few minutes earlier, that the spillovers are more intense and they are reciprocal. So there may be a self-interest in looking for any single central bank, in looking in that in those spillovers, because the effect of one central bank action on its domestic economy may be amplified by feedback loops coming from the outside. So that's the first case. And that case has been recently very much developed by John Taylor. And I think it's significant because John Taylor is not somebody who ordinarily would be very sympathetic to the idea of policy coordination. And actually he was one of the more vocal opponents of policy coordination when the issue was discussed a decade ago. And he has shifted in a way. He's come up with a series of papers. The latest paper is in the American Economic Association meeting in January. And I understand he's preparing other papers in that direction. And he's basically saying, well, my case, I'm oversimplifying what he said, but he was saying my case was that the gains of coordination were small. But now that everybody is deviating from what he called basic rules, which is the Taylor rules, so we had a great deviation, everybody's deviating from the Taylor rules, and everybody's pushing the others to deviate from the Taylor rules, so we're all coordinating on a bad equilibrium in terms of monetary policy. Then the gain of coordination in that specific situation become much higher, and there are interest in looking at that. He's built up at this stage, very simple model of interest rate interaction between two countries. I think, I don't know, I haven't talked to him, but I think he's developing something much more elaborate right now. But it's significant that someone who was so opposed to this idea is coming up very much in favor. I've listed at least two big questions we should face if we start thinking about this from a central banking point of view. First, does that mean that that central banks should have other objectives than purely domestic objectives? And I think that would be a real regime change from what we have known about the last 2 or 3 decades. That would mean a total different approach to central bank independence, a total different approach to monetary policy. And I would be walking into very uncharted territory, and I don't think any kind of central bank would really consider having explicit objectives, which would not be purely domestic. By the way, which objective should that be? So there should be discussion about it. So that's, in my view, a totally unrealistic proposal. And the regime under which central banks are looking at domestic objectives overall has yielded enormous benefits over the last 3 or 4 decades. So it would be unrealistic to think that there's any constituency behind jesusing that regime. So there's another interpretation about coordination between comma, which would say we realize that the spillover and the feedback effects are bigger than we thought and more complex than we thought. So we are going to try each to internalize these spillovers in our own policy making and hope that if everybody internalizes action with order, with sufficient coordination in information, for instance, then we can achieve a better equilibrium. That, in my view, may be something, and this is, I think, the kind of quote-unquote coordination that the general manager has been alluding in his recent speeches. I think it raises two questions too. The first one is that not everybody has an incentive to do that, and there are differences in size and exposure to external shocks, which may make for asymmetry in incentives in doing that. And the second is what I said during my former presentation, is that the mechanisms of transmission may be so complex and so unpredictable and so state contingent in a way that achieving efficient coordination might be technically impossible, or even achieving internalization of the interaction between monetary policy might be technically impossible. So I would conclude on that on a rather pessimistic note. I think there is a great advantage in pursuing deep exchange of information between central banks. There is a great advantage in being conscious about the reciprocal spillovers, including for big advanced economies. I think the danger, maybe that's my personal opinion, is that big advanced economies underestimate the feedback loops which I described, and that they can make mistakes in the way they manage the future evolution in their non-conventional policy because they underestimate those spillovers. So there is big advantage in taking those, internalizing all this. I don't see any more progress possible in this way except deep exchange of information and informal coordination. So the second issue is global safety nets. That's of course a very important place to discuss that. Between Korea has been a leader in the last 2-3 years for pushing for this concept, including when Korea was chairing the G20, and I was a personal witness to the brilliantness for which Korea has pushed for that concept. What does that mean? So we are talking about something which is very different from IMF-type facilities. We are talking about unconditional liquidity provision, first. So we are not in the IMF type. And second, in case, I would say, of aggregate liquidity shock across the world. So that's, I think, if I interpret the idea behind the global safety net, these are the two components. It's not idiosyncratic to a country, it's global shock, and it's unconditional. So basically, there are many ways of doing that, but I think the way most people who are pushing the idea have in mind is to have a permanent and not ad hoc network of swaps between central banks to face global liquidity shock. This raises traditionally two issues. The first one is moral hazard, of course. And as in any liquidity provision, there is a moral hazard problem because in times of crisis, we don't know how to distinguish a solvency problem from a liquidity problem. We have to accept that. This is totally impossible. So any kind of liquidity provision has an element of risk and potential loss. So that's the second bullet point. But it may make people less responsive and less able to take the necessary measure to ensure the insolvency. I think this moral hazard problem at the international level is the easiest one to deal with, although it's complicated. But I don't think it's unrealistic to think that we could agree commonly on what is an aggregate liquidity shock, and we could agree on a decision mechanism to trigger a global safety net, which would eliminate moral hazard. It would be very difficult, would be extremely contentious, it may take time, but it's not conceptually impossible, and even maybe politically impossible. What is more difficult, I think, is the fiscal implication. And there are fiscal, and this is something we learned too in the Euro crisis. This is our second lesson during the Euro crisis, that liquidity provision is not neutral from a fiscal point of view or even a distributional point of view. It has quasi-fiscal implication. Yesterday, Benoit mentioned very clearly the fiscal backing for the banking sector. So when you provide liquidity to a banking sector, you implicitly trigger some kind of possible fiscal redistribution. As I said, liquidity and solvency are hard to disentangle during a crisis, so you're taking risk when you provide liquidity and conditionally the risk. And liquidity provision means fiscal backing. So if we engage into huge expansion of liquidity provision nationally, internationally, at the end of the day, and this is the big debate between whether central bank should be lender of last resort to government or not, at the end of the day, and I'm speaking under the control of the president of the panel, of Professor Sargent, at the end of the day, for doing it in a totally safe way, you have to make sure that the consolidated balance sheet of the government and the central bank is compatible with the intemporal budget contract in all possible states of the world. And when the main liquidity providers are already extremely indebted, I think the limit, which I cannot determine, the limit is probably closer than it used to be when the old central banks, the old governments of major liquidity providers were not indebted. And that may translate very trivially into difficulty of getting the US Congress agreeing to a network of swaps or things like that. But this is not purely a political objection. There is something deep there between the ability of central bank to expand their balance sheet and the intemporal budget constraint of the governments. And again, the room for maneuver for that, I think, has been reduced by the tremendous increase in our public debt in advanced economies. So that is the obstacles for those of us who are pushing for global safety net that we have to tackle and to solve. And as much as I can see solution, at least theoretical solution from the moral hazard problem, from that problem, I think we have to think very hard on how we're going to deal with it. So maybe the only possible type of global safety net would be between what I would call a club of like-minded countries with the same approach to financial stability, which would translate into very consistent regulation and supervision mechanisms, and some kind of understanding about how any kind of cost linked to liquidity provision would be ultimately shared. And again, this very interesting speech by Hiroshi Nakaso 2 weeks ago, he has a sentence, very short, which says we will have to agree on the cost sharing before we have any kind of lender of last resort at the global level. So that's not, I'm not as negative as I was on the first point, but I think we should see the real difficulty where they are, and the real difficulties are where in the fiscal situation of the potential liquidity provider. Finally, segmentation. I think it's happening. It's happening inside the euro area, and it may be happening at the global level as well. I think we have whole tendency to have domestic liquidity regulation, to ask our banks to build domestic liquidity buffers, to have domestic capital requirements, to put an end to the kind of global bank model where you could have branches and not subsidiaries in many countries and manage your liquidity as a global bank on a worldwide level. And I think this is clearly, the tendency is clearly in the reverse model, having subsidiaries and capital and requirements which are segmented at the country level for reasons which I understand very well. But this is a tendency. I mean, so the banking world, and of course it may have been accentuated by the retrenchment of European banks and the deleveraging of European banks, which were the standard bearers with a few American banks of that global banking model. So the tendency is there. I'm not sure it's a good one. It may not help. So this is a matter for research. I'm not sure that a more segmented financial system will be necessarily less volatile. Intuition tells the contrary. The broader market, the more liquidity is, the less volatile it is when there are shocks. But this has to be deep, and this is purely an intuition at this stage. What I am certain of, and I will take this opportunity to develop this idea because I think very few people actually mention that. The big asymmetry in the world today, the big imbalance, it's not the current account imbalance. It's not even the capital flows imbalances. The big imbalances in the world today are imbalances in stocks of debt. The advanced economy, where still the biggest potential in terms of world demand is, have very high level of debt, between 80 and 100% of GDP. And the emerging world, where there's a lot of savings, not still, I mean, demand is growing, but in terms of mass, it's still not approaching the one is in the advanced economy, has 30% of debt to GDP. So this is a stunning reversal from 10 years ago. And these imbalances of stock would ideally need a lot of financial intermediation. You don't want this problem of imbalances of stock to be solved by each region separately, because that means clearly a very potential deflationary environment for the world economy, with excess savers not having assets to invest into, and excess indebted having to constrain their consumption to deal with that. So you don't want that. So in an ideal world, in a single financial system, you would like a lot of financial intermediation to deal with those imbalances in stocks. That means that's another issue for another conference. That means maybe that the focus of reducing current account imbalances is heavily misguided. So we may need net capital flows for a long time, but to get net capital flows, we need gross capital flows. And if we segment too much the financial market, the global financial market, we won't get that. So I think there's a deep something which is very deeply important in terms of policy issue there, and which is actually to build a very robust international infrastructure to get financial intermediation solid, not too fragile at the world level. And that would solve both, I think, the problem of the global safety net and the problem of the segmentation of the global capital market. This may be an idealistic vision, but this is the end of the conference. We are allowed to dream a little bit. And I think if we could achieve that, we would build the conditions for a very good rebalancing of the world economy. Thank you very much.
Okay, our next contributor is Timothy Lane.
Okay, thank you very much. So I'm going to focus the discussion on really a couple of questions. Can't say I'm going to actually answer the questions, but at least to give some observations. The first is, where is there a need for coordination, and to what extent do decentralized policies conducted in individual countries yield the right outcome, or to what extent would there be gains from moving to a cooperative solution? And then the other one is, to the extent the coordination may be needed, are the existing means of that coordination adequate, or would we need to devise something additional? Now, I guess the starting point is the context of global deleveraging that we've talked about, which is the after effect of the global financial crisis, and that has been a process in the countries that went through the crisis that has exerted powerful contractionary forces on the global economy. And in response, the central banks in the jurisdictions affected have cut their policy rates to historic lows, and they've expanded their balance sheets. And that's, I don't need to dwell on that because we've talked about that already considerably. With regard to the non-crisis countries, these policies, although they're designed with domestic objectives in mind by the countries that underwent the crisis, they can put upward pressure on other countries' currencies, and that, for countries with flexible exchange rates, tends to result in an appreciation of those currencies. Now, while that appreciation has a negative effect by itself, it also has to be taken in the context of the effects of those exceptional monetary policies on economic growth in the countries recovering from the crisis. And certainly, our analysis for Canada suggests that, although we're affected considerably by both economic developments and by monetary policies in our large neighbor, any effects on the exchange rate are much counterbalanced by the positive effects of recovery of economic growth in the United States. Now, I'm not saying necessarily that would be the case for all countries with large neighbors and spillovers. I mean, clearly that would depend on the structure of their economies and a number of other variables. But certainly it's important to consider the bigger picture, the positive effects on growth of these policies alongside of any adverse effects associated with the exchange rate. Now, the other element, of course, is that is to consider the response of the countries that didn't experience a crisis of the policies taken by their neighbors. And here again, I'm going to draw a bit on the Canadian experience, and certainly the effect of an exchange rate appreciation, other things being equal, is a drag on economic growth. And of course, there are a number of things driving exchange rates, and exceptional monetary policies may not be the only or even the major factor. But to the extent that these policies do have an effect on exchange rates, then other things being equal, it does tend to be a drag on economic growth in those neighboring countries. Now, other things being equal, of course, that implies that for those neighboring countries, if they're pursuing monetary policy on the basis of an inflation target, they're going to end up pursuing an easier monetary policy than they would otherwise do. And I have to say that goes in the same direction as the initial policies in terms of counterbalancing the forces that are leading to weak economic growth in the global economy. So, in effect, what's happened in that context is that, for example, deleveraging in the U.S. is resulting in very weak economic growth in the U.S. It's being met by a response from U.S. monetary policy. Part of that response is that the other things being equal, the US dollar depreciates vis-a-vis the whole range of currencies, including the Canadian dollar. And to the extent that that happens, it implies that other things being equal, Canada has a weaker economic growth profile, but the Canadian monetary authorities would counterbalance that by pursuing an easier policy, which in turn amplifies the effect of the monetary stimulus and also helps support global economic growth. Now, at the same time, though, this does have some costs for the country for the neighboring country, the smaller neighbor that experienced that did not experience the crisis. And here again, I'm going to draw on the Canadian experience as an example. And here, what we have seen is a buildup of imbalances in our household sector. Now, in part, this is a reflection of the fact of the following sort of dynamic. We've had the weakest recovery in our exports of any economy or of any recession in the post-World War II period. And in response, Canada has only been able to achieve economic growth through this period by relying on domestic demand. Now, in turn, that domestic demand has depended on an exceptionally stimulative monetary policy. Our policy interest rates are currently is currently at 1%, which by any historical standards is very stimulative, and that in turn has had the effect of encouraging greater household expenditure fueled by debt. So as a result, Canadian households are now more heavily indebted than Canadian households here shown with the red line creeping up are now more heavily indebted than their counterparts in the US or the UK. And in addition, in our housing markets, we've seen significant imbalances, both as reflected in the elevated share of residential investment in GDP and also as reflected in indicators of house price valuations. The other element, so that those imbalances are, in some sense, a result of this configuration of policies in Canada and globally. They're a reflection in part of the fact that Canada has had to maintain a more stimulative monetary policy than it might otherwise do because of the more challenging global economic environment. Now, that does not imply, of course, that Canada would be better off if the US were to remain in recession and were not to implement those stimulative monetary policies. This is just to say that there is a policy challenge associated with that particular policy configurations. Now, in Canada, of course, the consequence of this challenge is that we've had to think about the configuration of domestic policies. I mean, obviously, to the extent that monetary policy is geared towards an inflation target, we have to have other policies in order to counterbalance these growing imbalances in the household and the financial sector. So in Canada, we've actually had 4 rounds of tightening of mortgage regulations, and in part reflecting that, and then also in part reflecting expectations of households that monetary policy will, in due course, be tightened, and that current interest rates do not reflect the cost of servicing a mortgage over the life of a house. The households have actually started to rein in their spending, and we've seen some moderation of the imbalances, both in the housing market and also in the household sector more generally. So those are some observations of Canada, which I would say you can take them as they, for what they are in terms of how applicable they might be for other countries, but they at least show some elements of what we've been grappling with in this environment. But I think the bottom line is that we view the exceptional stimulus that is being provided in the countries that are still dealing with the after effects of the crisis as being, on the whole and on balance, a constructive thing that is helping bring the world economy out of a very weak economic growth pattern. Now, I qualified this initial discussion by talking about countries with flexible exchange rates. Now, there's clearly a different set of policy issues in countries that have less flexible exchange rates. And we've seen this issue play out both on the global stage in terms of the adjustments in China, for example, and also we've seen it within the euro area where you may have some similar issues at play. And the issue is that countries that didn't have severe effects of the crisis, that don't have flexible exchange rates, have been experiencing increased capital inflows, but instead of those inflows resulting in appreciation of their currencies, they've responded to a certain extent by restricting the inflows and to a certain extent by sterilizing them. Now, to the extent that the inflows are sterilized, this has the effect of counterbalancing the easing that's being carried out in the countries dealing with the after effects of the crisis. And so from a global perspective, in effect, it counterbalances the effects of the easing that's being carried out. So that is the issue for countries with less flexible exchange rates. But I'd like to step back from the sort of purely monetary aspects to the broader issue of external adjustment. And there, I guess the issue is that you have a configuration of savings and investment imbalances in various parts of the world that are unsustainable. And you need some element of deleveraging to go on in deficit countries, but that also has to be accompanied by a rotation of economic activity towards domestic demand in the surplus countries, and it also needs to be supported by some degree of real exchange rate adjustment. Now, in the wake of the crisis, there's clearly been very strong pressure on the deficit countries to undertake that deleveraging process, and that's true in the U.S., but it's also true within Europe in the countries that were most heavily affected by the crisis, the periphery of Europe. But in the wake of the crisis, while the deficit countries have felt pressures to deleverage, the surplus countries have felt less pressure to do the re-leveraging that's required to counterbalance that and ensure that the global economy remains on a more robust growth path. So work at the Bank of Canada simulates the effects of these sort of different alternatives for external adjustment. What's called, this is the good, the bad, and the ugly, that the authors of this piece refer to. The good solution is one where you have some degree of adjustment, both in exchange rates, but also in domestic demand in the surplus countries to complement the deleveraging that's going on in the deficit countries. And the effect of that is that you keep the global economy on a robust growth path. Now, in the case where you have delayed adjustment and where the adjustments on neither side, neither the surplus or the deficit countries undertake these adjustments, the outcome is a very weak global growth path, and that is one that results, according to Bank of Canada estimates, in a loss of global output of $6 trillion. Equivalent to $6 trillion. Now, an even worse scenario is the one with asymmetric adjustment, where you have deleveraging in the deficit countries, but you don't have the counterbalancing re-leveraging or a rotation of demand in the surplus countries. And in that case, you may have even larger losses in output. And so the ugly solution with the asymmetric adjustment is the one that's shown here with the green line compared to the bad solution, which is the red one. So this is an issue that's been taken on by the G20 some time ago, and already almost 3 years ago at the time of the Toronto summit, a framework was established for strong, sustainable, and balanced growth. And that recognizes that it's not just monetary policy, but it's the whole spectrum of policies, including fiscal and structural policies, that needs to be brought to bear in ensuring that we actually get onto the good solution and not one of the other ones. And so that is a track that the G20 leaders signed on to. But of course, the whole issue is implementation. And there, the G20 established a peer review mechanism to monitor progress in achieving the required set of adjustments on both sides. And in addition, of course, the IMF has its framework of surveillance, which is multilateral and bilateral, and that is, of course, complementary to the work that's going on at the G20 level. Now, finally, I guess I'd like to mention that apart from these issues of coordinating policies, there's a whole other set of issues of coordination, which is at the level of sharing information and having an exchange of views, analysis, and assessment. And just like to stress that that's something that we attach a great deal of importance to, and not only in a crisis context, but also under normal conditions, and also like to welcome events like this conference as a forum for doing that kind of sharing and cooperation. Thank you.
Good. Thank you. Our next participant is Fritz Zerbrugg. Thank you.
Thank you, Chair. These 1.5 days have been a real fascinating experience for me. I've listened very carefully to many insightful presentations, but as so often, when you come to a good conference, Usually you leave with many more questions than you had when you got here, and that is definitely the case for me. What I've also had at this conference, and please don't worry, this is not a failure of the organization, which has been perfect at this conference. I have no presentation, so you'll be faced with me on that screen for the whole 10 minutes. What I've also had at this conference were several déjà vus. I spent 8 years at the executive board of the IMF, and this was a period 1998 to 2006, and I can tell you I've spent innumerable meetings and hours of discussion regarding international policy coordination. At the time, I'd like to pick up two major issues that we're discussing. One, first was the SDRM, maybe some people remember this acronym, Sovereign Debt Restructuring Mechanism. The idea was quite simple, to agree on a globally recognized legal framework through which sovereign debt restructuring could take place. This approach, which required an international coordination, would avoid the more costly and inefficient case-by-case solutions that we had experienced in those crises. Using Jean-Pierre's words, a stunning reversal could also be detected there. If we go back and look what was 10 years ago, the focus there was very clear on emerging market economies. I remember very well the sort of condescending view many of us advanced economies had regarding countries, facing debt restructuring. I think looking at the Eurozone today, maybe things have slightly changed. The second topic, which was more enduring, was the issue of reducing global imbalances in the run-up to the financial crisis, 2007, 2008. Here also, the IMF tried desperately to underscore the advantages of multilateral policy coordination between major economic players. Unfortunately, there we had to wait for the crisis to do at least part of the rebalancing that was supposed to be done by coordinating policies. Now, this déjà vu in this conference comes a bit from the fact that in these 2 days I saw a bit the same trends that I saw in those 6 years at the fund, that policy coordination is an extremely elusive concept. I think many have already mentioned the issues, but if I boil it down to 3 points. First, we already have a problem of defining and demonstrating what is a problem, or even if it is a problem. And if we have defined it, it's extremely complex. I think we've heard many contributions in this conference. Second, where you stand makes a big difference. And I think considering and convincing a large player to play by certain rules is not easy, to say the least. Third, incentives are never fully aligned for all participants that could benefit from coordination, particularly if you look at over the medium and long term. So, what I'd like to do in the following is make only 3 points. First is restate maybe the obvious, namely that there is a strong case for autonomous country-specific monetary policies. Second, underscore the importance of existing international cooperating mechanisms. And third, maybe to bring in the experience of the Swiss case, that even extraordinary measures, exchange rate measures, can receive the support in the current framework. So, why do independent monetary policies make sense? Several points have already been made, but again, I would like to mention three reasons. One, a very important reason for all of us, I think, is democratic legitimization. Central bank mandates are embedded in national law. With these mandates, the sovereign confers responsibility in a crucial policy domain to a central bank. In turn, this responsibility, hopefully by an independent bank, will be implemented strictly according to its mandate. This, depending on historical experiences, preferences, structural peculiarities, is always aimed at maximizing national welfare. So again, these mandates, which differ from central bank to central bank, reflect these different experiences. The second reason, I think what we've seen in the past, is that each currency area has business cycles that are not always fully aligned across the other areas. Now, depending on where you are at the stage of the business cycle, I think it is a total different concept of how an individual central bank reacts. I think this gives a good element of flexibility for policymakers to adjust their policies specifically for the prevailing economic conditions. And the third reason focuses on structural differences. I think transmission of policy measures to the real economy depend very much on the economic and financial structures of a country. These structures determine the relative importance of different policy instruments and transmission channels, while in several countries, relatively large countries and closed currency areas, the US comes to mind, the focus is on the asset price channel. In Switzerland, a small and open economy, as is the case for Korea, I think the policy transmission is particularly important via the exchange rate. So, if I come to my second point, the importance of existing international cooperation, I think, Tim, you just mentioned a couple of points at the end of your presentation. I think it's important to remember that central banks have a long tradition of cooperating very closely in terms of regular exchange of information, sharing even at a very technical level experiences, problems, and this can be very important in terms of an informal coordination procedure. This intense cooperation also ensures that if the functioning of the international monetary system is really under acute threat, we can hope that there is scope for ad hoc measures. This, I think, was proven in the recent financial crisis. I think several of us have already alluded to the decision in December 2007. Federal Reserve, ECB, Bank of Canada, Bank of England, and the SNB announced coordinated measures in form of currency swaps to alleviate the pressures on the US dollar short-term funding markets. I think this was a unique situation where the incentives were fully aligned and enabled this ad hoc coordinated measure. More generally, international agreements and treaties provide an important framework for macroeconomic policy coordination. Now, despite the setbacks that I mentioned in the context of my IMF experience, I think the IMF plays a crucial role in ensuring that individual policies abide by certain rules. Now, for small open economies like Switzerland, which are not aligned in any G or in any bloc, these international rules are vital. This gives me the key to move to my third point and last point, the recent extraordinary exchange rate measure that the Swiss National Bank took. One of the IMF rules states that central banks must abstain from currency manipulation if this entails unfair competitive advantage. This is somewhere in the statutes, I don't remember exactly where. This means that interventions must be motivated to counter extreme problems, distortions, and must be in line with a respective policy mandate. Now, central banks which have a long experience in flexible exchange rate, do not usually resort to minimum exchange rates. So let me quickly give you the context of what happened. I think, Professor Kim, you mentioned the trilemma. Switzerland has a long tradition of flexible exchange rates. And we have a highly export-oriented industry, and this industry has coped very well with your normal volatility in exchange rates. And it has also coped well, if you look over the last 30 years, a trend appreciation of the Swiss franc. However, following the financial crisis, what we saw in the Swiss franc was a significant appreciation which went way beyond what we had seen over the last 20 years. And this pressure increased dramatically in 2011. It is, for many of us, already history, but if we go back into that 2011, we had the fiscal stimuli after the crisis slowly coming to an end, recovery of global economy that was actually losing strength, and on top of that, and more importantly for Switzerland being at the center of the European Union, the European sovereign debt crisis, and which had come to a peak. This all seriously undermined confidence in financial markets, and at this stage, and only at this stage, the substantial overvaluation of the Swiss franc became an acute threat to the economic activity, and not only that, it also threatened to undermine our mandate, given the downside risk to price stability. Now, before resorting to such an extreme measures, of course, the central bank went through all its traditional policy instruments, reducing interest rates to zero. They were already close to zero, increasing liquidity to dramatic levels, and this had no impact whatsoever on the franc appreciation. In Switzerland, we look very closely at the euro, and when in summer 2011 the euro hit the 1-to-1 parity, this is where things became very dicey. And on the 6th of September, my predecessors at the SMB set the minimum exchange rate of 120 to the euro. Now this is, for a central bank, I don't have to underline it in this conference, was a very, very serious decision to take with all its implications. I think we also stated, without wanting to paraphrase Mario Draghi, we also stated publicly that we would do whatever it takes to sustain that 120. What that meant, and fortunately Tim flashed over the various developments of balance sheets of central banks, but if you make a comparison, Switzerland comes out way at the top. This whatever it takes meant that we had to significantly and substantially intervene in foreign exchange markets, accumulating a balance sheet of which now amounts to 85% of our GDP. So that is the flip side of this, but the central bank was convinced and remains convinced that this was the measure, the ultima ratio, as they say, to actually fulfill our mandate. Now, we are, of course, glad that the IMF agreed that this does not constitute currency manipulation. You can imagine that for a central bank, it's important that not only do they receive support of central bank partners, but also of international institutions. Now, if I come to my conclusion, I think what we heard in these last days is that clearly spillovers have become more relevant, have become a more topical issue. While this definitely strengthens the case for coordination of policy makers, I would be very humble as to where we can go and how far we can go in policy coordination. I think it is clear that I'm talking now only for central banks, but I think it is also true for governments that the national mandate will remain at the focus. I think Jean-Pierre made all the necessary comments on this, on the difficulty of moving into a new world of coordinated global policies. And also, I think, let's not forget that we have institutions, we have our coordinating mechanisms, And I think this is something we should not underestimate. And here, my last point is exactly the same as Tim's last point. Again, as a small open economy, we are very strong supporters of international financial institutions, such as the IMF. We feel that this is an appropriate context not only to try to coordinate and at least exert some moral suasion, but also identify the issues and provide the necessary research. And of course, as Tim noted, conferences like this are actually are in a similar vein, and I have benefited very much from that. Thank you very much for your attention.
So thank you very much. Maybe at this time I'll open this up for comments or yeah, Robert?
A question for Tim. On page 13 of his handout, his last bullet was, from a global perspective, such sterilized intervention, partly offsets the effects of the monetary expansion in the post-crisis countries. Now, for the purpose of this question, I'd like to stipulate that the intervention has the form of the central bank buying, say, dollars, investing in 5-year treasuries, and sterilizing with, say, 1-year monetary stabilization bond. So from the perspective of the global bond market, you could say this is an operation twist, a cross-currency operation twist. So to the extent that sterilized intervention puts the reserve manager shoulder to shoulder with the central bank in buying the bonds in the key currency countries, can we be sure that the overall effect is the offsetting effect that you claim?
I think I have to think about that a bit more, but that's, I mean, clearly one could think of different scenarios in terms of the of how the intervention is carried out and also what the counterfactual is. I think implicitly I'm assuming the counterfactual is one where you have a flexible exchange rate and through the mechanisms I talked about, you have easing in the country receiving the capital flows. But I'll think further about your point.
I have a question on Professor Landau. You mentioned that global safety net is better to be made within the like-minded countries. But on the other hand, one of the motivations why we proposed global safety net in G20 Seoul Summit was the issue of accessibility to the international settlement currency. So many emerging economies actually do not have an ability to print out the international settlement currencies. But if you insist that this safety net has to be within the like-minded countries which may not have an accessibility to international currencies, then may that actually increase the demand for the more reserves, which is actually go against the motivation of suggesting the global financial safety net.
When I said like-minded, I didn't mean advanced. So I think I would say two things first. I would think of a sort of incremental approach, and so that a group of advanced and emerging economies would agree on basic principles about how they would manage their financial system, financial regulation, macroprudential issues, and on those bases they could maybe agree on a permanent safety net. So that would deal with the kind of moral hazard problems that are still very much lingering over that. So when I say like-minded, I said it's not necessarily universal. I didn't say it's only advanced countries. You're absolutely right. A permanent network of swap between advanced countries, it would make sense, but it wouldn't solve many of the problems of reserve accumulation, which comes from other parts of the world. But it doesn't have to be universal to be significant. That's what at least in the first stage. So that was my point. I also, as compared to 1 or 2 years ago, and again, as I said, going through the Euro experience, I realized that even between like-minded countries, liquidity provision can become very contentious. I was very sorry about the discussion about the target 2 balances, and I think it has been, the nature of those balances has been heavily misrepresented in many ways. But still, you can see that a pure liquidity provision, which is actually necessary to make a payment system work in a unified currency area, can trigger very, very unrational reaction, which implicitly raise the question of that fiscal backing. I think, again, the issue was very poorly represented, but for some part of the opinion, there was an equation in their minds, a wrong one, but which may be right in some circumstances, between liquidity provision and real and fiscal transfers. So we have to be aware of that, and I think I don't want to speak for the U.S. authority or whatever, but I think the institution of a permanent safety net may raise the same kind of irrational reaction in the decision-making system that we have seen in Europe. So from that point of view, as compared to 1 or 2 years ago when we had this discussion in the G20, I have become more sensitive to this quasi-fiscal aspect of fiscal provision. That doesn't change my mind. I think it's necessary. I think it's a good solution to the systemic issues of reserve accumulation, which may grow and to the point of being non-manageable. But I'm more for an incremental approach now for the reasons I said.
So this is more in the form of a long comment. So I'd like to move the robust in the title of the session to coordinate robust policies. The last thing we want is coordinated bad policies across the world. And if you think of where most of the advanced economies are, they're all at the zero bound. So that means a lot of the discussion we've been having about the exceptional accommodative monetary policy, we can't be sure that it's exceptionally accommodative policy right now. If you look at the chairman's testimony from 2 weeks ago, he talked about the fact, suppose that the US did raise interest rates. Right now, does that look like a robust policy to anyone? I don't think so. What would happen is you crash straight back into the zero bound again. So how can you think about robust policies? Well, the way the US has thought about it is first look at optimal control policies. So the optimal control policies tell us that for a long time, policy was hindered by the zero bound. You can try and make up that with LSAPs, with forward guidance. It's still going to be the case that under that optimal control point of view, which is not robust, you should have been you weren't really having an exceptional policy stance at that point. It was completely consistent with the economic situation in the US. Then you have to ask yourself how robust that is. So the US has been at the zero bound for 4.5 years. This discussion has been going on for a long time. And it's the same features keep on coming up about what could go wrong. And those things could still go wrong, but you have to make a decision at some point about which thing would you think is the worst thing to happen. And I think if you look through the Taylor rule, which is the standard metric that says US policy is exceptionally accommodative right now, you have to ask yourself whether something estimated in 1993 is really relevant to the situation today. So some of the things is, it assumes that the output gap can be reasonably well measured. We spent a lot of time in the Federal Reserve trying to think about how big the output gap is. The labor market suggests there's a substantial output gap in the US, separate from the CBO or anything else. And then Taylor assumes, which is the main reason we have exceptional accommodative policy under his viewpoint, that the equilibrium long-run real rate is 2%. So that might have made sense in 1993. It's not obvious it makes sense now, and in particular, it probably doesn't make sense given the kind of financial shock that we've just had. So the comment's more, it's really inspired by what Fritz said. So what the SMB did is a robust control situation. They didn't know what the outcome was going to be, and there was some massive cost for them doing what they did. They balanced those off and decided to take this very aggressive policy mainly because, as he pointed out, they were at the zero bound and they tried everything else, and the outcome looked very bad. So therefore, the right thing to do from the individual country was to do that.
Thank you. Do I see anybody else? Yes.
Thank you. I think new regulations that are driven by G20 are not necessarily accepted universally. And I see that there will be a tendency towards not globalization. I think the term, the old term prior to the global financial crisis was globalization. But we see from our perspective as a small emerging economy that we will be heading towards regionalization. It's region by region becoming more interactive with one another, and that will, coupled with deleveraging, less interaction between banks of advanced economies with those of banks in less developed countries and emerging economies and so on. I see that some type of segregation will develop in specifically around 2019 when Basel III becomes effective. I think that will lead to new architecture, new structure. Thank you.
Thank you very much. Okay. I'm going to abuse my, I'm going to make the last remark, picking up on something that Mr. Landau said. We talked about government-provided liquidity promises need fiscal backing. So I've been reading this book, which I can't get out of my mind, called The Battle of Bretton Woods by Ben Steele. And it's a struggle between John Maynard Keynes and Harry Dexter White to create a new financial architecture. And so one reason Keynes wanted to leave the gold standard for a reason that he got from Ricardo. I won't tell you what that reason is. It's the same reason that Keynes learned from Alfred Marshall. But if you kind of ask why did we ultimately leave the gold standard, it's not the reason Keynes advocated. I would say it was the temptation to transfer resources from creditors to debtors vis-a-vis a jump in the price level, or ultimately to impose an inflation tax. That wasn't Keynes's reason. He wouldn't have liked that reason, but that's why we did it. So you might ask, you might notice that we are coordinating today in some way. Even your line about the great deviation, that's a coordinated deviation from something. But so you might ask if we have this conference in 20 years, I won't have to come. But a question you might ask is, why did the United States leave inflation targeting? Maybe it won't, maybe it will, but I suspect it's going to be connected to the earlier one. But that's all. So I think it's time for lunch. Thanks. I want to thank the organizers and thank everybody for participating.